In the last video, we talked about inflation and interest rates. And when you think about it, inflation is actually a risk when you're making a loan, right? So if you're making a loan to someone at 5% interest for a year, then presumably you're expecting inflation to be less than 5%, right? If it's 5%, then you're just getting back the same amount that you lent in real terms. And so higher inflation is one type of risk that we can think about when we're thinking about interest rates and loans. And so what we're going to talk about in this video is thinking about risk more generally. The idea here is that there is a risk that borrowers either will not be able to pay you back at all or will only be able to pay back some of what they borrowed. And so the risk premia is the idea that with higher risk, you're going to charge a higher interest rate. And the reason is that there's some probability that you won't get paid back. So if you make a whole bunch of risky loans, then maybe 10% will default and won't pay you back, but the other 90% will pay you back. And because you charged a higher interest rate, you'll still be able to make a profit on those loans, right? And so the risk premium, we're basically going to put an extra term into our interest rates to be the risk premia in general. And it's going to depend somewhat on the risk aversion of the bondholders, right? If they are risk averse, meaning they don't like risk, they're going to charge a higher risk premium. And obviously, if the probability of default is high, they're going to charge a higher risk premium. So one of the reasons that the United States federal government can borrow for such a low interest rate is that they're looked on as having very low risk, both in terms of default, which they have not done. I mean, there's some story about there was a default in like the early part of the country, and states certainly have defaulted on their debt. But the United States has basically never defaulted on its debt. And inflation, right? So that's another risk for lending, buying a 30-year bond, is that you're worried that the country will have higher inflation, and so the real returns that you get will be lower. So how are we going to model this? Well, what we're going to do is we'll think of the interest rate as depending on some risk x. And so x is going to be the risk premium. So here we have little I is the nominal interest rate. So we have 1 plus I. And p is the probability of defaulting. So the probability of defaulting, if you default, then you don't pay it back and you get 0. Right? So that's p times 0. But if you don't default, that's 1 minus p, then you get 1 plus I plus x. And so the two have to be equal. So this term goes away, right? And then we're just solving for x. And so what it turns out to be, if we think of I as the if that's the risk-free interest rate, you might think of that as the interest rate for like the United States government. Then the risk premium is 1 plus I times p divided by 1 minus p. So let's do an example quickly. Let's say that I is 5% and that P is 10%. Okay, so now we have the denominator is 1 minus P, 1 minus 0.1, which is 0.9, and this is 1.05. Times 0.9, so here we can just do that quickly. We get 1.05, that's the 1 plus I, times 0.9, that's the numerator, 0.945, divided by 0.9, and we get 5%. So that would be our risk premium. And we can look at different types of bonds, right? So the yellow line here is the 10-year U.S. Treasury yield, and then we have AAA bonds, which are corporate bonds that are viewed to be very safe, and then we have BBB bonds, which are not quite junk bonds, which would be very risky bonds, but more risky bonds, right? And you can see that the triple B bonds pay a higher interest rate than the triple A bonds, and the triple A bonds even pay a higher interest rate for the most part than the federal government, although that they're both very low here in the sort of post-financial crisis period. You can also see what happened during the financial crisis, right, was that people were very worried about getting paid back, and so they demanded a higher risk premium from riskier borrowers, and they were more likely to go to what they saw as low-risk bonds, which actually pushed the interest rate of treasury bonds lower, right? So they wanted to buy treasury bonds. That pushed the price of treasury bonds up, which pushed the interest rate down. And so the interest rate for treasury bonds went down in the financial crisis, whereas the interest rate even for safe corporate bonds went up because you really didn't know who was actually safe and who wasn't. A lot of the mortgage-backed securities had been rated AAA and were failing because they didn't actually understand the risk that they took on. So we want to think then about sort of a more detailed view of the role of financial intermediaries. And by financial intermediaries, we mean really the financial institutions that make up the financial markets, right? So we've looked at banks to some extent. We've looked at bonds, so direct finance, borrowing directly from the ultimate borrowers. But a lot of what banks do is really to match people who want to save with people who want to borrow, right? So a financial intermediary will take in deposits or some other type of liability, and then they will make loans to people who want to borrow. And one of their jobs, one of the reasons that they're able to make a profit and that they benefit the economy in general, is that they take all of these different depositors and they find the people who want to borrow. They, look at the risk of those loans, and then they make those loans. And so they make a profit by charging a higher interest rate on the loans than they get on, than they pay on the deposits. So here, if we think about a bank, right, one of the things we want to think about is, how risky a bank is. And we can think about that in terms of either the capital ratio or the leverage ratio. And they're really just two sides of the same coin. So what is capital? Well, all companies, whether they're banks, financial companies, or really any company, have a balance sheet. And a balance sheet has assets, which are things that the company owns, and liabilities, things that the company owes to others. Now, for a bank, those things are financial. So for a bank, those liabilities are going to tend to be deposits or things like deposits. And those assets are going to be things like loans or, we talked about reserves as well, or bonds, which are really just another type of loan. Now, the difference between the assets and liabilities is your capital. And a company is bankrupt or insolvent when their liabilities are worth more than their assets. So, the reason that a whole bunch of banks failed in the Great Depression was that the value of their assets fell. They couldn't cover the liabilities, their deposits, and they went bankrupt. Similar thing happened in the financial crisis in 2008, but it wasn't so much with commercial banks, although there was some risk there, but with investment banks, companies like Merrill Lynch, Bear Stearns, Lehman Brothers. So here we have, in this little example, we have assets of 100, liabilities of 80, and capital is just assets minus liabilities, so 100 minus 80 equals 20. And so the capital ratio is just capital divided by assets, so 20 divided by 100, or 20%. And the leverage ratio is just the opposite. Assets divided by capital, or 100 divided by 20 equals 5. Now, why would you want a higher or lower leverage ratio? We'll talk about leverage here. That's, usually what I see. A higher leverage ratio means that you have less amount of capital, which means more of your assets are earning interest, right? And so you're making a higher profit there. But that's risky because the smaller is your capital, if your assets fall just a little bit, then boom, you're insolvent. And so there's this balance between making a profit and taking on more risk. And so when we talked about the required reserve ratio, that's one of the reasons that it exists, is to make sure that banks have enough, reserves to cushion any fall in their assets. And that's why we regulate banks. But that's also why financial institutions have tried to not be commercial banks often, right? They want to be investment banks or another type of financial institution that doesn't have the same capital or reserve requirements that a commercial bank does. So what happens when assets need to be sold? Well, now if everybody's trying to sell their assets all at once, that means the supply of assets has increased. And when supply increases without an increase in demand, then we know that price goes down. And these are often called fire sale prices, right? The idea like you had a fire and you need to sell everything from the house. And these prices would be below the true value. Now, obviously, the true value, that's a little bit tricky because it's the true value right now, but it might not have been the true value a year ago, and it might not be the true value in a year, right? And that's really the question. So when we think about the mortgage-backed securities, for example, that a lot of banks were trying to sell in the financial crisis, nobody was buying them because it was unclear how much they were worth. We just didn't know how far housing prices were going to fall. We didn't know how many mortgage holders were going to default on their mortgage. And so these banks really couldn't sell them. And that's one of the reasons that the Federal Reserve stepped in and started buying these mortgage-backed securities. So one of the things that financial institutions need to worry about is the liquidity of their liabilities, meaning how quickly can their liabilities basically disappear, right? So if we think about, a commercial bank that has checking deposits and savings deposits and certificates of deposits, checking deposits are very liquid, right? They're called demand deposits because you can go into a bank and demand all of your checking account all at once. Now, that's not true of a savings account or a certificate of deposit. They have a certain amount of time to give you your money from those accounts. Now, if I asked for all of my money from my savings account, it wouldn't be an issue because there's not that much in it. But if it was $1 million, then they could say, yes, we'll cut you a check in 2 weeks, or I think they have up to a month. But the idea is that the more liquid the liabilities are, the easier it is for a bank to become insolvent and face a bank run, right? Because if all of their liabilities disappear, then they're going to have to sell their assets in order to cover those liabilities, and they're going to face lower prices and become bankrupt. So this is exactly what happened in the 1930s, right? There's that scene in It's a Wonderful Life where everybody's trying to get their money out of the bank, and Jimmy Stewart is trying to explain how fractional reserve banking works. They don't have all of the deposits in cash. They have, their assets are in loans and mortgage loans and business loans, and so he can't give everybody's money back. And this is what led to lots of bank runs in the 1930s. People were very worried about the health of banks because of sort of follow-ons from the stock market crash in 1929, and many banks failed. Some people say we should not have fractional reserve banking. I don't think that's necessarily the right solution, right? Usually what we think is that as long as we regulate the banking industry well, then we'll have better luck. So one thing we did in 1934 was to introduce deposit insurance. So if you look at your bank account, it will say, FDIC insured, which is the Federal Depository Insurance Corporation, which basically means if the bank goes bankrupt, you're covered up to, I think it's currently $200,000 or it might even be $250,000. So one, don't keep more than that in your checking account, I guess. And two, most of the time you don't have to worry about losing the money that you have in the bank. We've also sort of had a liquidity provision so that banks could borrow overnight from other financial institutions. That's our federal funds market. And then there are other capital ratios, right? Like if we're talking about really huge banks like JP Morgan Chase and Bank of America, their balance sheets are a lot more complicated than a small local bank. And so what the Federal Reserve tries to do is make sure that their assets and liabilities don't represent too much risk. And so it's not just a capital ratio or a liquidity ratio that they have to meet, but they have to have certain types of safe assets so that they won't face a bank run that could potentially put them out of business, because those banks are so big that if they fail, we're in really big trouble.